So, picture this. It's literally New Year's Eve. The champagne is on ice. Everyone is getting ready to celebrate what has been historically, and I mean historically, one of the wildest years for money in decades. And then, boom, out of nowhere, the rug gets pulled. You think you're sitting on a gold mine, quite literally, and then the powers that be decide to change the rules of the game right at the buzzer. If you've been watching the charts, you probably felt that stomach drop on Wednesday because gold and silver, the absolute superstars of 2025, just took a nosedive. And the reason why is something that most people don't even pay attention to until it's too late. It wasn't a market crash, it wasn't a war, it wasn't some new law passed by Congress. It was a phone call, essentially, a decision made behind closed doors by the CME Group that forced traders to scramble for cash or get wiped out. You see, gold and silver didn't just fall, they were pushed, and understanding who pushed them and why is the only way you're going to survive the next few weeks of this market insanity. We are talking about the CME raising margin requirements on precious metals futures. Again. Yes, you heard me. Again. This is the second time in a single week. Can you imagine the panic? You're a trader, you're riding high on a 150% gain in silver, you're thinking about buying a boat, and suddenly your broker calls you and says, "Hey, remember that leverage you're using? Yeah, it just got way more expensive to hold on to it." That is exactly what happened. The CME Group, which is basically the referee of the futures market, looked at the volatility, the absolute chaos in prices, and said, "This is getting too hot." So they hiked the margins for gold, silver, platinum, and palladium. Now, why does this matter to you? Because when margins go up, leverage goes down. Traders who are over-leveraged have two choices. They either deposit more cash immediately to cover the new requirement, or they sell. And when everyone tries to sell at the same time to raise cash, what happens to the price? It plummets. It's a classic liquidity squeeze, and it's painful. But here's the dopamine hit you need to realize. This isn't necessarily the end of the run. It might just be the shakeout before the next leg up, or it could be the beginning of the end. Let's look at the numbers because they are staggering. Spot gold dipped 1.1% to around $4,339 per ounce. That doesn't sound like a lot, right? But when you consider it was at a one-week low and struggling to hold momentum, every inch matters. But the real carnage, the absolute bloodbath, was in silver. Spot silver tumbled 5.6% to $72.15 per ounce. Just days ago, it was climbing above $80 for the first time. $80 silver. We haven't seen action like this since the late 70s, and that's the curiosity gap I want you to sit with for a second. Why now? Why after a year where silver is up nearly 150% and gold is up 64%, do they decide to clamp down? Is it really just normal review of market volatility like they claimed in their statement, or is there something else going on? You have to remember, the CME said this decision was made to ensure adequate collateral coverage. That's fancy corporate speak for we are terrified that traders are going to default if prices swing too hard. They are protecting the house. The house always wins, right? But let's zoom out, because if you get too fixated on this one drop, you miss the monster rally we just lived through. 2025 has been a blockbuster year. I mean, gold is on track for its best annual performance since 1979. Think about that. 1979. Jimmy Carter was president, disco was dying, and inflation was eating the world alive. We are seeing history repeat itself right in front of our eyes. And silver? Silver has absolutely smoked gold. It's the volatile younger brother that crashes the car but also wins the lottery. It's up nearly 150%. If you put $10,000 into silver at the start of the year, you're looking at $25,000 now. That is life-changing money for a lot of people. But with those kinds of gains comes fear. Fear that it's too good to be true, and that is why this margin hike hits so hard. Investors were already looking for a reason to book profits. They were sitting on massive gains, looking at the calendar, seeing it's December 31st and thinking, maybe I should just take the money and run. And then the CME gives them a push. It's a perfect storm of profit-taking and forced liquidation. But wait, don't click off, because here's the twist. The fundamental reasons why gold and silver rallied, the interest rate cuts, the tariff tensions, the central bank buying, none of that has changed. The CME didn't fix the economy, they just made it more expensive to bet on it. The demand from India is still robust. The industrial needs for silver and solar panels and electronics, that's not going away. The tariff wars that President Trump is navigating, still there. In fact, gold was steady earlier in the week specifically because Trump eased some auto tariffs, which gave the market a brief sigh of relief. But the underlying tension is what drives these metals. It's fear. Gold is the ultimate fear gauge. When people are scared of the dollar, scared of the government, scared of the future, they buy gold. And right now, despite the drop, the fear is still very real. Now let's talk about the why. Why does the CME care? Well, they're the ones left holding the bag if a trader goes bust. If you buy a futures contract and the price moves against you and you can't pay, the exchange has to clean up the mess. So when volatility spikes, and boy has it spiked, they raise the rent. They say if you want to play at this table, you need to show us more money. It's a risk management tool, but for the little guy or even the medium-sized hedge fund, it can be a death sentence for a trade. Imagine you're holding a long position, you're convinced gold is going to $5,000, and suddenly the margin requirement jumps. You don't have the cash on hand, you have to sell. Your selling drives the price down, which triggers stops for other people who then have to sell. It's a cascade, it's a domino effect, and that is exactly what we saw on Wednesday. But here's the insight that separates the pros from the amateurs. Smart money knows this happens. They expect it. In a historic bull market, margin hikes are actually a sign of strength. It means the market is so powerful, so volatile, and so one-sided that the regulators have to step in to cool it down. It's like a speed bump on a racetrack. It slows you down, sure, but it doesn't change the destination. Or does it? That's the question you need to ask yourself. Is this just a speed bump, or is the bridge out ahead? Because let's be honest, a 150% gain in silver in 1 year is insane. It's parabolic, and parabolic moves usually end in tears. But then again, 1979, everyone thought that was a bubble too, and it kept going way longer than anyone expected. The comparison to 1979 is fascinating. Back then, it was the Hunt brothers trying to corner the silver market. Today, it's not two brothers, it's a global phenomenon. It's central banks in the East dumping dollars for gold. It's retail investors waking up to inflation. It's a totally different beast, but the charts look eerily similar. And that's the dopamine kick-in, the pattern recognition. We love seeing patterns. We love thinking we know what comes next, but the market exists to humble us. Just when you think you have it figured out, the CME raises margins. Bam, reset. Now, I want you to think about the psychology of the trader who bought silver at $80 earlier this week. They are down almost 10% in 2 days. That hurts. That is real pain. And that pain is what fuels the market. For every winner, there's a loser. For every person popping champagne tonight celebrating their 150% gain, there is someone staring at a red screen wondering where it all went wrong. That is the brutal beauty of the commodities market. It takes no prisoners. And the CME, they're just the landlords. They don't care if price goes up or down. They just want to make sure the rent gets paid. And right now, the rent just went up. Again. The fact that they did it twice in 1 week tells you everything you need to know. They are nervous. They are seeing order flow that scares them. Maybe they see a crash coming. Maybe they see a melt-up. But they aren't taking any chances, and neither should you. You need to be looking at your own portfolio right now and asking, am I over-leveraged? Because if the CME raises margins a third time, and don't think they won't, could you survive it? This is the reality check. The news headlines will say gold falls on profit-taking, but the real story is leverage gets punished. It's a tale as old as time. The market gives and the market takes away. But let's pivot back to the macro picture for a second. We mentioned interest rate cuts. The Fed has been cutting rates, which usually weakens the dollar and boosts gold. That trend is still intact. We mentioned tariffs. Tariffs create inflation and uncertainty. That boosts gold. We mentioned demand. India loves gold and silver. That demand isn't vanishing overnight, so the fundamentals are bullish, but the mechanics, the margin requirements are bearish in the short term. It's a tug of war, and right now the mechanics are winning, the technicals are winning, the guys with the calculators at the CME are winning. But for how long? That's the cliffhanger. Can the bullish sentiment overpower the margin hikes? Can the sheer weight of demand from central banks absorb this selling pressure? If gold can hold $4,300 and silver can stabilize above $70, we might be setting up for a massive January. The January effect is a real thing. New year, new allocations. Funds reset their books. They might look at this dip and say, "Thank you very much, I'll take that discount." So while the headline is scary, prices fall, the opportunity might be staring you in the face. Or it's a trap, a bull trap, a classic fake-out before the real crash. That's what keeps us watching, right? The uncertainty, the thrill, and let's not forget the other metals. Platinum and palladium also got hit with margin hikes. This was a coordinated strike on the entire precious metals complex. They didn't miss a spot. It shows you that this isn't about one metal, it's about the asset class. The hard asset trade became too crowded, too many people on one side of the boat, so the CME rocked the boat, and a few people fell out. Are you one of them, or are you holding fast? You know, it's funny in a way.